Welcome back to the Deep Dive, the place where we uh, really try to cut through the noise of corporate earnings reports.
Right, and pull out what actually matters.
Exactly. Today, we are strapping in for a deep dive into Dollar General Corporation. We've got their Form 10Q and the press release for the third quarter, which ended back on October 34, 2025.
And this is a really fascinating one. I mean, this isn't just about a discount retailer. It's more like a masterclass in how a company can, well, engineer profit while its main customer is under some serious financial stress.
So our mission here is really to get past the raw numbers, the percentages, and understand the strategy behind it all, the why behind what they're doing.
And success is definitely the word. I mean, some of these numbers are pretty eye-popping.
They really are. At first glance, you see net sales are up a solid 4.6% to $10.65 billion.
Yeah.
Okay, that's good. But the real shocker is the bottom line.
Mm-hmm.
The diluted earnings per share, the EPS, it didn't just grow.
No, it surged.
It surged. We're talking 43.8% up to $1.28.
Yeah, and that's the puzzle we have to solve right now. I mean, how do you generate a, nearly 44% jump in profit on just a 4.6% increase in sales? It tells you right away the story isn't just about growth.
It's about efficiency.
It's all about how efficiently they generated every single dollar.
Okay, let's unpack this. Let's start with those sales components.
Right.
So 4.6% net sales increase, fine. But the key number, the health of the stores, is same-store sales growth. And that was 2.5%.
Which is healthy, definitely healthy. But the way they got there, that's what tells you everything about the consumer right now.
Absolutely. The filing gave us the exact breakdown.
And it's a huge insight. The entire 2.5% SSS growth was driven by a 2.5% increase in customer traffic, just more people coming in.
And the kicker, the average transaction amount, how much each person actually spent.
Flat.
Completely flat. A 0% change.
It's the clearest signal you could possibly get. The value consumer is not feeling better. They're not making bigger purchases. They are, basket editing, hunting for the cheapest items, maybe making more small trips.
So DG is winning on frequency, not wallet size.
Precisely.
It's almost like Dollar General is becoming the new corner store for their customer base. You go there to grab one or two things to get through the day, not for the big weekly shop.
Exactly. But even with that, they saw sales increase across all their categories. Consumables, seasonal home, apparel, everything was up.
Which suggests they're still capturing that tiny little discretionary purchase.
They are. And operationally, they are turning all that traffic into serious cash. Year to date, their cash flow from operations jumped 28.4% to $2.8 billion. They're just incredibly efficient at converting a sale into cash.
And the product mix really emphasizes that essential focus. I mean, consumables, the lowest margin stuff, is still almost 83% of sales.
Which brings us back to that puzzle. If customers are spending the same amount per trip and focusing on low-margin essentials, how on earth did the profit surge?
That's where the margin management comes in.
What's fascinating here is that exact contradiction. I mean, the customer behavior should be squeezing their gross margins, but the gross profit rate actually expanded. It went up by 107 basis points to 29.9%.
That is the story right there. It means DG is fighting the external pressure with just incredibly tight internal engineering. So what are the drivers? What do they credit this to?
Two big things, both about operational control. Lower shrink and higher inventory markups. Let's zero in on shrink because, wow, this is where the real success is.
And for anyone listening who isn't in retail every day, shrink is a huge deal. It's basically inventory loss.
Right. It's the gap between what your books say you have and what's actually on the shelves. It covers theft, errors, damages, everything.
And they've had lower shrink for 5 consecutive quarters now.
5. That takes a massive, sustained effort. They are winning the internal war on product loss. And every dollar in product you save from being stolen or damaged, well, that just drops straight to the bottom line as pure margin.
And they specifically mentioned that damages improved in the first 3 quarters of 2025 as well.
So fewer items lost, fewer damaged, and they're just running leaner overall. It shows up in the numbers, too. Inventory turnover went from 4.0 up to 4.4. And on a per-store basis, inventories are down over 8%.
They're just tying up less cash per store. It's incredibly sophisticated.
Right. But that doesn't mean all costs are cooperating. If you look at their SG&A, the selling, general, and admin expenses, that rate actually went up.
Up by 25 basis points to 25.9% of sales.
Yeah, so even as they're becoming these efficiency superstars, the basic cost to operate the stores went up.
So what was pushing that SG&A number up?
The filing points to a few things. Incentive compensation, which, makes sense. They're rewarding these operational wins, but also rising costs for repairs and maintenance and utilities.
So paying more to keep the lights on and the buildings running.
Exactly. But the genius here is that the 107 basis points they gained in gross margin from controlling shrink was more than enough to soak up those rising costs and still deliver that massive EPS surge.
So the profitability story is almost entirely about internal engineering, not about the customer spending more, which brings us right back to that value-conscious customer.
And management is very, very clear about the headwinds their customers are facing. They don't mince words.
No, they say the majority have low or fixed incomes and are feeling, quote, constrained. That's the world they live in.
And the filing details exactly what's crushing those household budgets. I mean, it's a whole laundry list.
High costs for rent, healthcare, energy, fuel, and just, stubborn inflation on food and basics.
This is the context. This is what forces that pattern we saw. More trips, but no more spending per trip. Consumers are just triaging their budgets, and DG is where they go for the emergency essential purchase.
And that reality makes them really cautious about government programs. They call out risks like potential cuts to SNAP benefits or unemployment.
Right. Any reduction in that safety net hits their sales almost immediately.
And they get really specific, which I found interesting.
Oh, yeah, the student loan detail.
Here's where it gets really interesting. They specifically mentioned the federal government reinstating collections on defaulted student loans starting in May 2025.
That level of detail is crucial. It shows they are tracking exactly where their core customers' already tight cash flow might get even tighter. Any dollar that leaves that consumer's wallet is a risk to them.
Okay, so they know their customers stressed. But despite all that, Dollar General is charging ahead with a massive, aggressive physical expansion plan. Let's get into the strategy.
The scale is just staggering. For fiscal 2025, they have 4,885 total real estate projects planned.
And they're not slowing down. The look for 2026 is another, 4,730 projects?
It's a profound bet on long-term square footage growth. Just a massive bet.
And to manage that scale, they have these two different remodel programs. There's Project Renovate, which is the full, deep remodel.
All right, about 2,000 of those a year.
But then they had this lighter touch program, Project Elevate.
Yeah.
About 2,250 of those planned.
And that Project Elevate is really an efficiency play. It's about optimizing the layout, sure, but it's also about preventing future high repair costs. It's that same margin discipline we saw in Q3, just applied to their real estate.
And the new stores they're building are also strategic. The majority are going to be these larger 8,500 square foot formats.
Yes. And why that format?
Because it lets them put in more coolers, expanded high-capacity coolers.
That's the competitive edge right there.
Yeah.
That is how they fight the big grocery chains. You expand your fresh and chilled foods, and you drive that crucial customer traffic we talked about. You give them a reason to stop by for milk or eggs.
So they're spending big to become a real quick-stop grocery competitor.
Exactly. And they're also investing in digital, the DG app, delivery partnerships, same-day home delivery. It's all about convenience.
But the real tension in their strategy becomes obvious when you look at their specialty format. Pop Shelf.
Ah, yes. Pop Shelf. They have about 180 of those. They focus on higher margin, more discretionary stuff like home decor.
So given everything we've just said about the constrained customer, what's happening with Pop Shelf?
It's being pulled back dramatically. They're citing the, quote, softer discretionary sales environment, and they are pausing all new store openings for Pop Shelf in 2025 and 2026.
Wow. That's a major capital decision.
It's huge. They're basically saying they don't believe that discretionary spending will recover enough to justify new investment anytime soon. And some of those Pop Shelf stores are even being converted back into standard Dollar Generals.
That one decision to halt discretionary growth while plowing ahead with thousands of essential-focused stores tells you everything you need to know about how they see the next 2 years.
Absolutely. So let's shift to the balance sheet because they're managing their capital just as deliberately.
They're all in on stability over maybe short-term growth. They repaid $1.1 billion in debt year to date.
Using cash on hand. And they plan to redeem even more notes in Q4. And this focus on paying down debt led to a really critical decision.
Pausing the share repurchase program for all of fiscal 2025.
That is a huge signal to the market. Pausing buybacks can sometimes disappoint shareholders who want that short-term stock boost.
So why do it?
Management said it very clearly. It's to preserve our investment-grade credit rating and maintain financial flexibility. They're signaling that long-term access to cheap capital is more important than a short-term stock pop.
They're building a fortress balance sheet.
Right, to support that huge expansion plan. But they did maintain the dividend, which shows confidence in their cash flow.
We also saw some expected management changes. Donnie Lau is officially in the CFO chair, and we saw a note about the departing executive, Stephen Deckard, getting a $2 million payment to extend his non-compete.
Yeah, details like that are important for looking at long-term continuity, but let's touch on a couple of really complex tax things here because they matter. DG's effective tax rate actually went up a little bit, from 23.2% to 23.6%. That was mostly because of the international Pillar 2 minimum tax.
Right, Pillar 2. That's the global effort to make sure big multinational companies pay at least a 15% tax rate everywhere.
So that's a small outflow. But then domestically, they got a cash flow boost from something called the One Big Beautiful Bill Act, the OBBBA.
And that act is expected to significantly decrease their U.S. cash taxes this year.
Right, through things like bonus depreciation. So you have global rules raising the paper rate a tiny bit, while a domestic policy is lowering the immediate cash they have to pay out. It all feeds back into that debt paydown strategy.
Okay, moving to risk factors.
Oh.
The filing, of course, disclosed the ongoing shareholder securities litigation.
Yes, and the related derivative litigation. The core of it alleges that management misrepresented the impact of certain store labor and inventory practices.
DG says they believe it'll be resolved without a material adverse effect, but they have to acknowledge that, litigation is always uncertain.
Of course. But ultimately, that amazing Q3 performance allowed them to raise their guidance for the full year.
Right. They bumped up their net sales growth forecast to between 4.7 and 4.9%. Same-store sales growth now targeted at 2.5 to 2.7%.
And the really big lift was on the bottom line. Diluted EPS is now projected to be between $6.30 and $6.50.
Which just confirms their confidence that the internal engineering, especially that shrink control, is sustainable enough to keep delivering profits.
Even if their customer doesn't start feeling richer anytime soon.
So what does this all mean?
I mean, it means Dollar General has shown this remarkable ability to control its own destiny internally. They're facing this really squeezed customer, rising costs, and yet they delivered soaring profits by just mastering the basics of retail shrink and inventory.
And at the same time, they're strengthening their balance sheet, pausing buybacks to pay down debt.
And they are aggressively betting on their physical footprint. Almost 4,730 projects planned for 2026, all focused on capturing more of that essential spending.
With the pause on Pop Shelf being the clearest sign of how they view the consumer reality right now.
Which leads us to the final provocative thought for you to consider. DG's strategy is built on two conflicting realities. On one hand, you have them investing billions in aggressive square footage growth, betting on a future where they can capture massive market share.
And on the other hand,
they openly admit their core customer is so financially stressed that they're making these tiny flat spend multiple times a week trips just for the bare essentials. So the question is, how long can they successfully sustain that massive capital spending for growth when the data shows their customer base is just so fragile, so constrained by forces completely outside of their control?
it's a real tension between growth, optimism, and consumer austerity.
It's the tension that defines the entire discount retail sector today.
Thank you for joining us for this deep dive. We'll be back soon with more insights from the filings that shape our world.